Mario, buddy, how's your weekend going?
Hey, yeah, everything is going okay so far. Let's put it that.
Did you end up getting that social distancing drone footage that you're talking about for Thailand?
No, not really. That's actually funny because um, I try to make some impressive things where a lot of people are cramped, but usually they're under some roof, so I cannot really get them.
So, how's your trading been going this week?
Kind of mixed.
Is that because of
Um,
the volatility, or
yeah, volatility is pretty much up in the Forex markets, but liquidity isn't, and that causes some problems for a lot of a lot of traders.
well, it's funny that because a lot of people have this misconception that volatility is somehow a good thing for people like you and me. It's You'd argue that it's probably one of the worst things you can deal with as a day trader.
Yes. Okay, let's there are different kinds of volatility. I mean, if there is genuine volatility and like prices moving because there is something behind it and there is the liquidity that supports it, then volatility is not really a bad thing. But the common misconception is that if the markets are volatile, you can make faster money, but that's just not true.
Right, and a lot of that comes from these lifestyle traders, right? They're the ones that perpetuate this kind of idea that they catch hundreds, if not thousands, of points in a single candle, so to speak.
Yeah, basically that's what it comes down to. But if things can go up, they can go down as well. So if there is high volatility, that basically means you must have larger stops. And so in the end, at the end of the day, you're making the same money, basically.
Now, you're trading primarily currency pairs, in other words, Forex. Do you dabble in anything else, like indices or metals?
Occasionally, I trade some indices like ASX, the Japanese stock index Nikkei, and the DAX, German index.
And that makes up something like 10% of your trading, or how often would you trade those?
Less.
Less.
Let's say 5.
Why do you choose those markets? Is that because there's a bit of a downswing sometimes in momentum, or you get a bit bored and you move to those markets, or you feel comfortable, or what's the reason behind trading the indices as opposed to 100% Forex?
I have a good and a bad answer for that question.
I'll
Which
take
one do you
both.
want to hear?
I'll take both.
Okay, the bad answer is revenge. If I'm not making any money by trading currencies, I usually trade the DAX because it's very expensive and you can get wrecked really fast, but you
Yeah.
can also make some really fast money. But for the ASX and the Nikkei, this is just like currency trading, basically.
Right, more steady.
Yeah. But I trade all of them on CFD basis, so the spread is usually horrible. So it's
Right.
most of the time comes down to the DAX or the Hang Seng Hong Kong stock index. I forgot to mention that one.
For these people who are listening in on this podcast, they probably might not be familiar with foreign exchange trading. There's this idea that you're in and out in a matter of seconds, or you're holding as a scalper or just a day trader in general, that you might be holding a position for a really short space of time. Can you talk us through what your trading style looks like, what positions you might take, how wide your stop losses are, and just your overall general strategy for Forex trading, if you have one for across the board? Because I know you trade differently for different currency pairs, but as a general rule of thumb, how would you describe your trading?
And I follow 2 trading strategies, but they are both basically in essence the same. They're just different about how I enter the market. I'm a range trader, which makes me a swing trader. But yeah, that's also something we should address about this common use of words, which is completely non. Most people, if I ask 100 people, 90 of them will say I'm a scalper. Because like 6 months ago, I bought the Australian dollar with a 1 point pip stop, 10 points, and went out with like 6 pips profit. that makes me a scalper for some reason. But I just traded the structure. Like I enter on the VWAP and I exit on the structure. So that essentially makes me a swing trader. But yeah, let's go back to the strategy. My main strategy is I'm buying where the volume is, which is the VWAP. And usually I trade reversals and exit at the nearest structural resistance or support. The other strategy is exactly the same, but I enter on support and resistance and ignore the VWAP. But this is something I do on larger time frames only most of the time.
So can you talk to us a bit about the VWAP strategy? Sometimes I've watched your streams, and sometimes you'll short at the VWAP, or you'll wait for it to go through the VWAP, and then you'll use that as support and you'll enter that position. Can you help define what a structure looks like? How do you define a structure, and how does the VWAP fall into that structure for your trading?
Yeah, with the VWAP, I basically cut the range in half, because the VWAP is usually in the middle if markets are ranging. That's a downside for the most people, but it's a very, very massive upside for me, because my risk reward is accelerated massively by doing. Let's give you let's just take an example. We are inside a channel. It doesn't really matter what it is, a triangle or a vertical channel. It doesn't really matter. Just there is some sort of channel, and there's maybe a slight slope up. Then we're expecting that the price gonna go higher, but we are below the VWAP, so that means it's more like in selling territory. But that doesn't mean it's gonna go higher. But for me, the confirmation is the VWAP itself. So price will go from below, cross the VWAP to the upside, and then retest the VWAP from above. And this is where I'm buying. And the VWAP itself, like you said, becomes the support. And if this support is being broken again, I'm simply wrong. That's how I managed to have like especially on the Australian dollar pair. I can do these trades without 1 pip stop, maybe 1.5.
To a lot of people, that would seem crazy and pretty obscene to have a 1 or a 1.5 pip stop. But you'd chalk that all down to the VWAP being something that's more than a retail trading indicator, right? You'd say that's used by industry?
Yes, but that's not really the reason for it. But yes. VWAP is the average of the volume, meaning where the VWAP is, there is the real volume. And institutional traders, of course, use that as the best, because the volume is accumulating in that price range, which is very, very narrow in Forex, by the way. And they're gonna get the best fill. So if a large bank or a large institution is gonna buy the Australian dollar, they're gonna do it at the VWAP, and then price is gonna move like instantly. That means for you as the day trader, as a retail day trader, instant profit. That makes a major difference.
Let's talk a little bit about your risk to reward. Now, do you have any defined risk to reward, or is that entirely dependent on your structure that you were talking about?
Yeah, now I can again give you a good answer and a true answer. Okay, the good answer is you analyze the situation, like you're making just standard price action, you're making your trend lines. Let's just say there's a triangle forming. We are in the second wave of the triangle, so there will be a third one. This is just common that this will happen before the breakout. But let's just say the triangle is at that point, at the third wave, the triangle is like, okay, let's just say it's 10 pips wide. The VWAP is in the middle of it, because there is no, like we are like in the beginning of the session or something like that. That means my first target will be 5 points from the VWAP. And the spread is like 1.5, and they're going to have a 1.5 point stop. Then that makes it whatever, 3. So I'm risking basically 3 to make 5. That's a bad trade, but I would still take it. That's my bad answer, by the way. So, but you analyze the situation and you see, okay, there's a high probability that this is going to turn here, that this is going to go back up, and then at that point, when you get this idea, this is going to go back up from here, you just see, okay, there is enough room to the upside to make this actually worthwhile. This is all I do in matter of risk reward. But back to the bad answer, usually I take the trades anyway because it's fast in, fast out, kind of scalping, kind of.
And what percentage win rate would you say that you have?
My win rate is actually very low, about over like 4,000, 4,500 trades. My win rate averages at 43%.
In terms of profitability, so people would typically hear that and they'd go, right, you're a terrible trader. But that also comes down to how you manage risk to reward, right? So if you're risking 1 to make 3, you can afford to be incorrect 60% of the time. So what does your, I don't want to say profit, because I know no trader likes to discuss their profitability as a dollar figure, but can you give us an idea of perhaps in terms of percentages, what amount of profit you make per day or per week with a 43% win rate?
That's actually a very good question. I'm averaging about 23 to 32% a month. Oh, that's wrong. That's 30 trading days. That's not a month. That's
right.
Because I record my trades and then I just add another day every time I trade. So this is not counting any off day.
So you'd be targeting on average 1% a day in that case?
Yes, but this is... No. Well, mathematically, yes, but it's not... I just don't want to make this impression that I make every day 1%.
Sure.
I have a lot of days where I make a lot less money. So, well, mathematically it's correct. I just don't find the right word to say it. 0.5% here and 0.3 there and 0.6 there. And then there's one day I make it like 4 or 5.
Right. On average, you'd say 1% a day, or at least that's how it ends up mathematically, right?
Yeah,
Okay.
But it's to put it more realistically, it's a lot less than that. Let's say 0.5%, something like that. You have like 0.7, 0.3, 0.5, something around that is always kind of fluctuating. But there are days in between where when you just hold a position and you say, okay, this is not the day where you scalp. This is a day where you hold on to the position. And if you have if you are in a trade with like $10 million, you're buying like 10 million Australian dollars against the Japanese yen and it moves 40 pips, that's a 20% profit or something like that. And then if these days they make a major difference, but I just don't want it to sound like, oh, he makes 1% a day. That's just not true.
How long have you actually been trading for, specifically Forex and indices?
Indices, like forever. But and Forex signs, I mean, seriously trading Forex signs about 2008, something like that.
So a good 12 years. Now, out of those years that you've been trading, including indices and Forex, how long did it take you to become profitable?
About 6 years, but not this 6. Not in this Forex years. I had quite a history before that. I traded a lot of grains futures, but this was a completely different style of trading. This was over the phone.
Would you say that your history in trading back over the phone and trading things like grains, would that have contributed? Would you have learnt and applied those skills from before into Forex? Or was that a completely different field and nothing's transferred over?
It's a completely different field. It's a completely different type of trading because you're trading more or less cash. But price action wise, yes. I keep saying if you can trade one market, you can trade all of them because it's just price that moves and it moves always the same. Or sure, there are characteristics to it. Like I take it like even if I trade like, okay, I trade an Australian dollar, and tomorrow I trade maybe the British pound, which is both Forex, but they react differently. And you need some sort of experience to do that. And like if you trade grains or in general commodities, they have exposure to nature, as example, which you don't have that seriously in if you trade money. So there are different aspects to it that moves markets. But at the end of the day, the only thing that matters, the only thing that really makes you money is the price itself.
What is it that made you move into Forex from trading things like grains?
Liquidity. Most of it was liquidity, and that is available like always. You can trade it like 24/5, basically.
And once you started Forex, now I assume you were profitable at trading grains?
Yeah, but this was kind of an investment kind of trading. I would like to get into that about the price action kind of. What I did back then, I had this. Do you know these school math papers you have?
Oh, the grids.
Yeah, the grid papers. I used this kind of paper, and I made basically my own point and figure charts. I basically maintained by hand with a pencil a 12-hour point and figure chart.
So you were charting by hand?
Yeah, because I called the broker in the morning and placed my order, so he's gonna execute at CME in the afternoon for me then, but for his then in the morning. And at the end of the day, more or less, I called them again, and then I get 2 updates a day, and so I had a 12-hour point and figure chart basically. But at this time, I didn't actually know that. I mean, I wasn't aware of what I'm creating. But this came apparent rather quickly, and then a transition to another market. If you only look at price, things are really, really easy, basically.
So how'd you go with grains? That's an unusual one. I don't think I've heard anyone trading grains. Did you move out of grains because it was too boring, or did you hear about Forex and the liquidity and you just went, right, I don't want to deal with this pen and paper stuff anymore?
I hate fundamentals deeply.
So you're telling me you don't pay attention to any news whatsoever? It's purely technical analysis for you?
Yes, now it is, but before it wasn't. Like I said, like if you trade any commodity, there is always nature involved. Okay, nature is something you can have fairly control, the weather, blah, 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 all this kind of stuff. But then there's a hurricane somewhere, and then the crops you have futures on are just dead, and then you're gonna sitting on them, and you're gonna be afraid they're gonna actually deliver them to your house. So what are you gonna do if you cannot sell them?
Has that ever happened?
No, that's never happens. But legally it could happen, but no, that's never happened. Unless you're actually in this business and you want them for real. But
right.
For a trader, that's not really happening.
So when it comes down to Forex, you signed up. From that point in time, I guess, how did you learn to trade? How did you apply what you learned before? Because you were doing hand charts. Did you have to learn things like chart patterns by yourself, or did you research it online? Tell us a bit about how you started out Forex trading, what that looked like for you, and what's changed since.
Oh, I did it like everybody did. Get money, get rich fast, get easy money, high leverage, and all this kind of stuff. And going from a cash-based market into a highly leveraged market is basically giving a 3-year-old a loaded gun.
I love the analogy. Yep. It's funny because I was trading for such a long time before I first touched leverage. And I thought, if I'm profitable without leverage and then I touch leverage, that it'll just be fine. I'll amplify my profits. But that did not end up being the case. I actually haven't touched leverage since. I try and trade cash. But obviously in Forex, you have to leverage, right? And make any kinds of money, because you can't make money with your own cash. So when you signed up, how much would you say you lost in your first year or two, or before you became profitable, how much would you say you spent loading up and blowing up accounts?
All in total?
Yeah.
Maybe $100,000.
Now, at what point did you go, this is gambling and I should stop?
Never.
Why did you keep going?
I don't know. I'm addicted, I guess.
It's the competitive nature, right? You've got to just keep going till it works.
Yeah, something like that. And the idea that, making money with money, that especially appealed to me. And that's actually what makes Forex, it's in itself so not lucrative, interesting. Like, because you're literally making money with money.
When you first started trading, how long did it take you to become profitable? Now, you mentioned 6 years, but that included your grain trading. But from a purely Forex perspective, how long would you say since you first signed up that you started noticing you were getting consistently profitable? Not just profitable, but consistently.
Oh, that went down pretty fast. I paid my school money, blown a lot of accounts, and then just, okay, you have to get your shit together, and then just do what you did before, and fine tune it from there, basically. And like, you're taking off the training wheels at some point, and then you're starting to apply the leverage properly, basically. This took about maybe 2 years. Yeah. So I spent like $100,000 over 2 years.
And I would argue that's a pretty normal amount of time for someone to become consistently profitable. I think no matter who I talk to, 2 to 2.5 years seems to, for whatever reason, just be the number. So whenever I do webinars and such, that's the first thing I tell people, is to set that expectation, because they would have been looking online left, right and center, getting these resources that, you know, these Lamborghini traders, these lifestyle traders with a laptop by the beach, and, you know, come take my course, this $150 course, because I'm a millionaire and I need your $150 to, you know, feed my lifestyle. And they get this idea that profitability can come quite easy. So the first thing I tell people is, particularly for trading stocks, is at least 2 years. Set that expectation of 2 years. And for purely technical indices-based trading, I try and set the expectation of absolutely no less than 6 months. But I find it really interesting that that is a consistent number that I keep hearing, is 2 years. Do you think that comes from the steep learning curve? Do you think it comes from stubbornness or just ignorance, and that it just takes that long for you to realize that, hey, I'm doing it wrong, and then you need to change your ways, and that if you had your time again, that maybe it would take maybe 1 year or possibly 6 months if you just started from scratch and you applied the appropriate learning tools that you've done? Would you say it could take a lot less time?
No. Because it's the devil inside of you that makes this time up. Learning a strategy, like everybody is selling, like you said, all these Ferrari traders, they all say, learn my strategy. Learning a strategy is easy. It's going to take you 15 minutes. Just take a moving average, crossover, whatever strategy. It doesn't really matter if it's good or not. You just need something to grasp on. It's going to take, how long going to take you? You watch like 5 YouTube videos and then you have it. This is not something difficult to do. Strategy is such a small part. The psychology is the most important part. And this can take time until you get over yourself, basically.
So what sort of psychology tools, or what sort of things do you do in your day-to-day to manage that psychology aspect, controlling your emotions, for example? Is there anything that you apply, or is it simply just being aware of what you're doing every time you trade?
Well, the funny thing is, even if you're aware of it, you're not going to stop doing it. Like, recently I had an event like that where I was live on YouTube and I said it. This is not going to work, but I did it anyway.
Can you talk us through that trade?
I cannot exactly recall it, but there are many situations. I'm being quoted quite often about that when I say this is not gonna work out, but I'm taking the trade, and that is usually what kills you if you're having a bias that is proven to be wrong by the price itself, and you're still hanging on.
What happens in that situation? You take the trade, you close it out. Do you look back at it and you go, that was really stupid, I'll probably try not to do that again? Or do you just accept that sometimes as a human being, you will be stubborn, you'll fall to psychological traps, and you just move on? You just accept it as a loss and just deal with it that way?
I just take it like it is. Just, okay, that was dumb. I'm proud of myself that I made this claim in public before I actually did it. But generally speaking, you're still gonna do it. For me, there's no way to stop doing that. You just have to keep your risks in check. And usually what I actually top that up by revenge trading. But, and that usually works, actually, to be honest. Revenge trading works. But you need to be very, very, very strict about what you're doing and how you do it. Like, let's just say, okay, this is not going to work. Like, we're buying something and it keeps stopping. And at some point, you have to cut your loss. And that's why I also trade small, because then I can just afford doing that. I can just double the position and say, okay, now it's all on. And that is what I meant by revenge trading. So, like, I'm having a 0.1% drawdown, and it's a hedged position. I reverse the hedge position instead of closing it. That essentially means I'm doubling.
In the opposite direction, right?
Yeah, but then it doesn't work either. I'm hedging it maybe again. But at that point, you have to make a decision. So you're waiting for the next setup. You're setting a hard stop. You do the revenge trade and you walk away, because if that fails, the loss is going to be too great that you can recover from it. Usually it works, so it's not a big deal.
One thing you do that I find really interesting, and I learned this from yourself actually, is you don't see how much you make per trade. You don't visualize on your screen. You can't see the dollar amounts per tick. You can't see any dollar signs whatsoever.
Oh yeah, that is a very, very good point, because okay, let's just say you're average person and you have whatever, what's the average income in, let's say $5,000
a month?
Yeah.
Yeah, maybe we can go with that.
Yeah, okay, let's just go with $5,000. Okay, now yeah, let's just say you have $50,000 on your account.
Mm-hmm.
And if you lose, like, okay, you lose a trade and you lose $500, and then you're gonna think, even if you do it subconsciously, I mean, even if you don't really realize that you do it, but if you see the money, you're gonna think, this is 10% of my salary what I just lost.
Yeah.
And then you lose another trade, and then this comes up, this is my rent, or this is so what I'm getting at is, when you associate the money you're losing or making with things you can actually buy, that is when things go south. That is very, very, very bad. And that's why I prevent that from happening by not seeing this information. But, well, I know how much money I have on the account, and if my P&L indicator shows I am 0.1% in profit, I know how much money that is. So that only works partially. But it definitely helps by not seeing. I have a P&L window, but it's detached from my main application. It's on a different screen, and I have the Discord on top of it, and another helper chart and some other windows. So I actually need to make a few clicks to actually see this window, and this is on purpose. So I cannot just look up and see my P&L. If I revenge trade, I trade exclusively the money. Like, if price goes up into my favor and I have like a $275 loss, well, whatever, whatever, $358 loss, I will close this position at $358 because
Right.
I'm over leveraged, I'm oversized. If it pulls back, that's gonna make me an even larger loss. So my main aim is getting my money back. Not recommend to anybody to do it. This is just me doing that.
Sure. So what is your rule when it comes to risk management? What do you have in place to manage risk?
I'm doing visually. I see visually my drawdown, basically.
Mm-hmm.
And this is where things are actually getting very, very complicated in the general view of like 99% of the people. Because the problem is if you have just one position, like you're buying a stock or whatever, you have just one entry, you have a hard stop, and this stop is gonna define how much you're gonna lose, and that's really all that matters. Never ever count unlaid eggs or unhatched chickens. This is just very, very, very bad. All you have to focus on is how much you're gonna lose by doing what you're just about to do or what you're going to. And the next thing is scaling. Scaling in a loss, especially, can accelerate your gains massively. But this is gonna come down, and then the general idea of martingale coming up, and this is a completely different thing. But doing that can be extremely complicated if you use a standard trading platform, which doesn't give you the idea about how much exposure you're gonna have on your first trade and on your second trade. You're gonna need staff that calculates that stuff. I mean, if you make this trade in like 10 minutes in and out, you don't have the time to make these calculations. So I have a custom indicator that actually does these calculations for me. I can see visually with a horizontal line where my maximum drawdown is gonna be. So if I scale in, like if I'm in a buy position, price goes down basically against me, and I keep buying it, this line will move closer to my average entry because I'm having more size on, and that means my maximum drawdown gonna occur further. So I can just keep pressing the button until this maximum exposure, this visual line of my maximum exposure is actually at a point where I'm really wrong. And by doing that, I always trade with the maximum possible size.
So as the position gets lower and lower, towards a technical stop loss, basically. So you increase your position as it goes against you, but it's a planned. It's planned, right? It's not like you're just like, oh, I'm losing, I'll just add more. It's a planned stop loss, and you get heavier and heavier on your position as it gets to that stop loss. Is that my correct understanding?
Yes, basically that is what it is. Your best entry will be your best entry will be at the stop loss.
Right.
Basically. And that is also what most people getting wrong. Like they're entering on support or whatever, and then they have a stop loss somewhere below. And when the price goes down, goes towards the stop, they're already feeling bad about the trade.
Right.
But if you see it from a different point of view, like, oh, the price is gonna go down and it's gonna actually test the stop out level, then that's good for me, because let's just make a mathematical example. Like I'm having a 10-point stop and I can buy $1 million at this point. If the price goes down 9 points, I could buy another. How much did I say? Sorry.
I think it was 1 million.
Yeah, I said if I will bought just 100,000 at this point where I'm originally entry, and the price will go down 9 points, I could buy 9 million and I will have exactly the same loss when the stop is gonna be. But if the price is gonna go back up as expected, this is gonna be on my original entry. I'm gonna be massively in profit already.
Right, because the upside, there's so much more upside and minimizing the risk. So that's one of the things that I've actually applied to my trading as well. I thought that was kind of a real revolutionary way of trading stocks. I actually heard you say that at one time, and I kind of applied it to my trading. and I realized how much less I was losing. So like you said, instead of buying at support 100% of the position and setting a 10% stop loss, it's now I'm buying 30%, and then I'll want the trade to go against me. So then it gets closer to my stop loss, and I can put in the rest of the 70% of the trading capital that I was planning on. And then if I get stopped out, I lose significantly less, but I also make significantly more profit if it swings back up in my favor. But the only downside to that, I guess, is if it bounces off the initial 30%. But that's a really good thing for psychology, right? So even if the trade goes in your favor on a small position, you're still making money. And then when you trade the initial position at 30% and it goes against you, would you not argue that's a really, really good thing for your psychology? It changes the way you think about losing money.
Yes, exactly. Because like you said, you're going in with 30%, which is a good number. And then I basically do that to 20 to 30%, something like that. And then price just takes off because you bought support. I mean, you just had a good entry, and then price just takes off, and then you're gonna be angry because you're not making any money. I mean, you're making money, but you could make so much more. So this is kind of reversing your psychology because you're gonna be angry by making money. And let's just take the other scenario. You enter the position with 20%, and then price actually goes against you, and then you're gonna feel good about it because now you can buy more.
And you'd argue that picking the bottom is just something that just doesn't happen statistically very often, right? So that's why putting in your first position at a low percentage of your initial trade is such a good thing.
Yeah, that's correct. And you never pick the bottom. I mean, we're not trading for Instagram. We're trading for money. So you're just taking a piece out of the market and be happy with it. And if you can put in as much size as possible, so the better.
What is the risk percentage of your entire trading portfolio? What is the maximum percent that you'd lose in a single trade or a single structure?
I'm not so sure what you mean. You mean a setup?
Yeah, a setup
in itself, or just a
because you have multiple trades in a single setup. So in that entire setup that you have, do you have like a 1% risk tolerance or 1.5, 0.5? Is there like a maximum rule that you have, or do you just kind of go with whatever feels right?
It's 0.3.
Just permanently zero. You'll never lose more than 0.3 in a single setup.
Yeah, well, I lose more, but yeah.
that's
the idea
target.
is the idea is 0.3, and then I'm gonna start to protect myself by either closing the position or hedging, because let's just say the 0.3 occurs like this is about the dynamics of the market. Let's just say I trade a reverb reversal. It's right at support. I mean, there's structural support, there is the VWAP at the same level, and I'm buying the reversal. I will go in very, very heavy on that, because there's a very, very high chance that this is actually going to happen. But if it doesn't, I'm probably going to hedge it and wait for a setup to the downside to get rid of the position. But my initial buying idea of this symbol is still given. So maybe let's just say I'm going to hedge it. It's going to retest a larger time frame support, and I'm just going to close the position, my hedged position actually, at the next support and buy there again, which would double my exposure. But I already made money on the way down, and I can just reinvest that money by allowing a much larger drawdown. Let's just put that in numbers real quick. Let's just say I have a zero. Let's just make it 1%, but I would not recommend any day trader to do that. Just for the ease, we have a 1% limit. At this 1%, I'm going to hedge myself, which is 10 points away, and 10 points is too far for an intraday structure to get rid of. unless you double down. But you cannot do that with 1%. I would not recommend to do that.
Right.
So now we have a 10-point gap between my average buy and my average sell. But there is like a 40-point drop possible to happen to the larger time frame support, to the underlying structure. So let's just assume this is gonna playing out. So we're going another 40 down, which makes a total 50 to my average. And at this point, I'm gonna make the same trade. It's gonna be a structural trade, not a volume trade, by simply closing my sell position, which protected my buy, and buy maybe 50% or maybe even 100% at this new support or at this underlying structural support. And at this point, I'm gonna have on display, like I have this 1% with 10, so that I will have a 5% loss on this original position, but I capitalized already a 4% gain, so I'm still at -1. Nothing has changed. The price just. So in essence, I have a 5% loss on my original entry, but I took a 4% profit on my short sell, on my short positions, which I reversed to a buy position at that point. So I can simply afford to do that. But that is what I meant before about being very, very serious about pulling the plug, because if that one also fails, you're going to have a 2% loss.
I've tried hedging, and I, for the life of me, seem to end up being that person that ends up with a 2% loss every time I try hedging. It seems awfully simple as a concept, but extremely difficult to execute. How often do you hedge, and would you agree with the sentiment that it is extremely difficult hedging as a strategy?
That's actually a very good question, because I'm using the difficulty as a reason. No, not a reason, as a decision. Let's just take the previous example. If I have a 10-point stop, I would, okay, let's just say 6 months ago. If I had a 10-point stop 6 months ago, I would not hedge that, because I would need to wait forever to find a setup where these 10 points fit in just for a break-even trade.
So we're talking about pre-COVID-19, basically.
Yes.
Yep.
Like on Australian dollar, Japanese yen, I made trades with a 1-point stop, 1 pip stop, and a 6 pip target. So if I would hedge at -2 or -3, and I mean we are in a triangle formation or something like that, the range is going to be so narrow. The next setup I'm going to have will not provide enough range to get myself out of the trade. So basically the market structure itself tells me to hedge or to take the loss.
So would you say hedging is a way for you to adapt to current market situations then?
Yes. Let's just do a practical example. Like I'm buying a VWAP reversal, and the VWAP breaks, but like 3 or 4 pips below is okay, let's make it 5 pips below is support, solid support structure. I'm gonna hedge there. I'm gonna be very heavy on the VWAP because I want this trade to work, but I have confidence if it doesn't work, I have another chance to get it off. And that's why I would not hesitate to hedge very fast when it fails, because if it's gonna go down, test the previous support, and I'm gonna just take it from there. But if we're in the middle of nowhere and you have a very large distance to your limit or to where the range is just telling you this is not gonna work out, it's usually very hard to get out of these hedge positions, unless they are extremely small, and then you just don't care.
Having been in your Discord for quite some time, would you say that risk management is basically everything when it comes to trading?
Everything, yes.
So you focus more on risk than you do on profits?
Yes, actually, when people ask me where is your target, and then I many people know that I usually say I don't know. I haven't looked yet because I see when I open I always I have 3 linked windows. Like on Ameritrade, you can do the same in CTrader.
Yeah.
And I see if I switch to some symbol, I can see immediately the 4-hour chart, 15-minute chart, and the 3-minute chart. So, and I'm making most of the decision of the first few seconds. I see this 15-minute chart, and then I look at it. Okay, this is gonna go up. That's it. I'm gonna buy that. That's all I do, seriously. And then I'm just gonna wait for the price to move at like it crosses the VWAP and it makes a retest of the VWAP, and I'm gonna just start buying it. And when I'm in the position with a meaningful size and I have actually a stop set, like usually I make a horizontal line, and then okay, this is gonna be where my stop is gonna be, and then I'm setting a hard stop because you cannot focus on what the price is doing, and then I just zoom out or go to the 15 minutes and I actually find a target. But the initial decision to make this trade came from just looking at it for a few seconds. Like, okay, this is gonna go up. Okay, let's buy it.
How often would you look at a chart?
What do you mean?
What I'm getting at there is humans by nature will try and find a pattern if you look at something hard enough. Do you have a rule that if you only look at a chart for maybe no longer than 30 seconds and move on? Or do you find yourself finding patterns where patterns don't exist if you look long enough? Do you have that problem?
Yes, every human has that problem because it's in human nature. Humans are really good in recognizing patterns. I mean, that's how we work, basically. That's how everything works. And that's a problem in trading. That's a big problem. And that's why I have a 7-second rule. I open the chart. Like I said before, I have linked charts. So I can see 3-minute, 15-minute, and 4 hours immediately when I switch to that symbol. And then I look at it for about 7 seconds. That's why I keep saying the 7-second rule. If I don't see anything in that time, do something else. Because it's just like you said, if you look long enough, you're going to find something.
It's interesting because people are aware that humans by nature are good at recognizing patterns. That's why they think it's kind of a consensus that people think it's a good thing to look at charts for longer. But you raise an interesting point that there's after 7 seconds, if there's nothing there, then well, there's just nothing there. You'll make something eventually. And I think it's good to point that out because I don't think many people actually realize that that's not a good thing to keep looking at a chart. Now, I want to move on to something I haven't heard you talk about before, and that's your community and your YouTube channel. So I noticed that you live stream and it uploads onto YouTube. So some days you trade for 12 hours live, anywhere from 4 to 12 hours a day. And you've got about 300 episodes last I checked. What was your decision to live stream, and what was your decision to set up a community Discord, which from what I can tell is entirely free?
I think it's about 900 episodes or something like that.
Oh, okay. Well, I missed that by quite a bit.
I just crossed the 800 trading log yesterday. No, yesterday was 801. Yeah, it must be more than 1,000 because I started logging later.
That's logs with live streaming? That's entirely live stream logs?
Yes. Like yesterday was a good
Wow.
example because I switched my trading account to another account and I just ended the log because I'm doing something else now. I'm still live, but because we were talking, and so never mind. Let's just keep going, doing what we're doing. But I'm trading on a different account, so I'm not logging that because it's gonna falsify my statistics as well.
Right. So what made you start live streaming?
The initial idea was proof of concept.
And what was the proof
Basically.
of concept?
That trading works.
And after 900 or so episodes, would you say it works?
More or less, yeah. well, how do I put that? Well, if you're a day trader, it's kind of a lonely kind of thing, so you need to get some company to. But and you need some sort of verification as well. You need to feed the ego in some way. And that was a good idea to do that. And then the idea was actually to do some webinar kind of stuff where everybody can share the screen and we talk about the setups and why we do them and why we don't do them and stuff like that. Some like a 24/7 classroom, something like that, but for free. That's not about the business.
So,
And
where does Discord fall into all that? Did you make Discord at the start of your live streaming, or did you kind of tack that on?
That Discord was, it's more or less the same time. The idea was, like doing a webinar, and I went to go to webinar and log me in, and there are a few very professional applications, but they're hugely expensive.
Yeah.
Or they just don't work. I mean, they're just crap, to be honest. I mean, yeah.
No,
So-
I know exactly what you mean. I've run through so many webinar applications, and I charge people like $5-10 just for a webinar, just to cover the costs, and it's like $150. Some of them charge $500, and the application is absolutely horrifically garbage. So I totally get what you mean there. So is that where you just decided you'll just do live streaming and you'll have a Discord and you'll just kind of abandon that idea, or are you just waiting for some sort of application to come out that'll suit your needs, basically?
No, I tend to hang on to my things, so no, this is never gonna change. But what the initial thing was, like, Kenny had a webinar running, which was also terrible, and he upgraded then to a very, very, very professional one. And then I asked him, "Wow, this software is awesome." And he does the same what I does. It's free, all is free. And then he just said, "Oh, it costs $2,500 a month."
Oh,
And I said, "Okay, we're done here." And then I discovered Discord. I'm not a gamer. I mean, I'm a kind of a gamer, but not that serious. I'm just doing some Red Dead Redemption. But and I discovered Discord, and they just came out with the beta version of the video conferencing stuff, and I said, okay, this could fit in nicely because they doing all out, so I can use them as my user base, so I don't have to program all this stuff by myself. And so this is pretty much a go-to thing. But Discord took like years to roll that out. I mean, just like two months ago, they officially rolled out the video stuff with live streaming inside a voice channel. But Discord proved to be pretty good and stable, and it does the job more or less. And now Discord forms the Swingfish user base. So in order to be a Swingfish member, you have to have a Discord account, basically.
And what do you mean by Swingfish member? Do you run your own platform, like a website with some paid services, or can you tell us a little bit about that?
No, but as you just say that, I was just like 2 hours ago thinking about a paid service, but this comes in much later. But Swingfish is actually a brainchild of mine, basically, where this ideology is being very, very seriously pursued. That this kind of knowledge you can get for free off YouTube or wherever. You don't have to pay for that. And the Swingfish project as such will remove completely and indefinitely the conflict of interest. So it has to be free at all times. There cannot be any hidden cost or any under the table profits being made. Like, okay, I'm recommending this broker because I'm a B partner with them and stuff like that. Like if you go to the Swingfish website, there is a broker section, and like half of these brokers, I have no partnership with them. Like Pepperstone, as example, it's an Australian broker. They're very good in what they are doing. They have outstanding support, but they do not want to partner with me because my company is in Singapore. And they had some run-ins with Singaporean legislation, so they just decided not to do that. But that doesn't stop me from telling people Pepperstone is a good broker, because they are.
Now, you mentioned you're an IB. Do you give back the profits from affiliate links, or is that something you keep?
Yes, there are brokers that are affiliated with my company, and like IC Markets as example, which is by far the best, even better than Pepperstone, by the way, by far the best C-Trader broker for the C-Trader platform only. But yeah, that's just a fact. And that has nothing to do that I'm affiliated with them, but this is why I'm affiliated with them, because they provide the best service on the C-Trader platform. But to keep this conflict of interest, I mean, to make sure there is no conflict of interest, if somebody is in the Swingfish community, signs up using the IB links I provide, that means you're gonna get 100% refund of all the money this link gonna generate. And this is public record, because IC Markets have on their website, if you make an inquiry about becoming a partner, they're gonna tell you how much the money they're gonna pay you, and as being a partner, if you bring in new clients. So this is 100% transparent, and people just get all of that back. So in essence, I'm providing free money instead of charging people.
Now, if you didn't give back that IB affiliate money, because I don't know anyone that's an IB, an introducing broker, and returns money to the people that use the affiliate links. How much would you say you get in affiliate links in terms of profit per week, assuming you didn't give it back?
Maybe between $17,000 and $25,000 US dollar.
And that's on a weekly basis.
Yeah, but this is all brokers combined. It's not just one.
Sure. So a lot of people would look at that and go, "Wow, I could retire on 17 grand a week on affiliate links." So why do you have this sense of community to help people out? Why is there this free platform, this free education system? Are you just secretly a communist, Swingfish?
Social communist, maybe. But I'm German, so I cannot use this kind of words because it would automatically label me as a Nazi. So it's a bit of a problem. But yeah.
But you make enough from trading that you don't need to make money from other people effectively.
Yeah, that's if you know how to trade. You don't need to take. I don't need the $9.95 from somebody who's barely making a living. That's just
right.
There is no moral in doing that. I mean, what's the point in general? But of course, if that's your business model, then that's a different thing. But that's just not it. I'm more the transparency kind of type of, like, people. I have a lot of enemies, mostly these shady educators that do it the other way around, and regularly get told I know where you live and
oh really?
What? And I say, yeah, well, just type my name in Google Maps, then you can see where I live. So, because I have no privacy concerns at all. So.
Oh, that's something I didn't know. You're getting effectively death threats from people who are providing paid services. That's unusual.
Yeah, because I'm not being nice to them at all. I mean, if it's clear what these people are after, then
right.
Okay, there are two things. If you're doing that as a business, like like there are prop trading firms, as example, they have all of the prop trading firms have two streams of revenue. Like one is the accounting part, where they basically make money even if the trader never trades live, and the profit sharing part where the live traders share the profits. But if you more aim on making traders fail because you're gonna charge them a monthly subscription fee, and the longer they take to realize that they're never gonna make it, the more money you're gonna make, I'm gonna tell these people that this is just very, very evil.
And that's a very common business model as well.
Yeah, but if you make that clear on your website, that this is what you are doing and this is your choice to make, then so be it. This is just a business. But if you sell the Holy Grail, knowing that all of them or most of them gonna fail, that you don't even try to make them successful because what you offer is not gonna make you any profits, then that's just not the way things should be.
Right.
Same is with leverage on brokers. It's basically the same idea. Like I said before, I pre-COVID-19, I made a Aussie yen trade with a 1.5 pip stop. And I do that with 1 to 100 leverage, risking 0.3% of my equity. So having more leverage is just pointless because you cannot have a smaller stop. That's just not possible because your spread is going to be already more. So you're going to get stopped out by the spread. So
right.
But like I said, I do that with 1 to 100 leverage. And on my private accounts or on the company accounts, I trade without anybody seeing. I usually have 1 to 200 leverage, but this is for different reasons. So if there's a broker who say, I'm going to give you 1 to 1,000 leverage or 1 to 3,000 leverage, they aiming for you to lose money.
100%.
That's it.
Now,
because there is no point on this earth to have this kind of leverage because it's not going to facilitate anything more than risk.
Now, can you tell us a bit about Enfoid prop trading? How did you start that business, and do you have some sort of platform for anybody to trial to become a prop trader?
Yes, but about this trial thing, I'm currently revamping that. I'm getting stronger and stronger the idea that trials not lead to the expected outcome.
Are you getting lots of applicants applying and trialing to hit your targets? Because you set a target of, what is it? It's 10% profit in a month or something like that?
Yes, you have to make a 10% profit, but this is only in the first round. You have to make a 10% profit in 30 calendar days and minimum 10 trading days. And that means, let's just round it up. You have to make 10% a month, in 1 month, in one single month. And that is just designed to put pressure on a trader and see if they still can handle their exposure. So you're not over leveraging, you're not taking crazy positions with massive risks or not allowing massive drawdowns. If that's basically the idea behind that. The system doesn't expect you to make that kind of returns on a normal basis. And that is actually a serious problem because most people actually try to do that. But it's probably my fault on the way how the website is designed, because people really think that is what they need to do. But this is not the case. Actually, the traders that have the most funding, I think the highest account is $780,000 at the moment, US dollars.
And you fund that.
And yeah, and this trader makes like 2.5% a month. And if you make that kind of returns, like on a 1 to 10 equity-based risk reward, like that means you're risking 0.2% to make 2% in a month. There is unlimited capital for you. I can call up hedge funds that give you like serious money. But if you make 10% a month, you're never going to get more money. Never, ever. Because the exposure to make that kind of returns is too great. And the most people don't understand that. This is a very, very hard challenge, I think.
So how many people to date do you think have signed up and signed up for the trial, and how many have actually successfully become a prop trader for your business?
There are two ways of signing up. One is where you pay a security deposit, which is 1% of the equity you're going to trade. Not the buying power, because lots of the competition just advertising buying power, but this is just nonsense. I mean the actual capital you're gonna trade with. You have to deposit. Let me just rewind a little bit. The Envoy Lender system is an investment platform, basically a savings account, a cloud-based savings account which pays interest. And in order to become a prop trader, you have to have one of these accounts. And the requirement is for fast enrollment is that you deposit, that you essentially make a 1% investment of the capital you're going to trade later. But this is not a fee. This is just something you have to put down. And you just can take it out once you're qualified to trade live. That's this is just so you actually make a financial commitment to show that you are serious. And on the business end, the company is going to use that money to pay an option against this equity later for live trade. There is another way to do that, which is free. And that requires you to be a community member in the Swingfish community. You have to be somebody like the moderators, and we have another group that's called First Mates. They know about you. So somebody is knowing that you not just talk nonsense, you know what you're talking about, basically. And then the company is going to just come up with the money and buy the option for you, and you don't have to put down any money. But this is designed not for the average Joe, like for somebody living on welfare in the UK. That's basically meant for somebody who lives in a hut in Africa, or just doesn't have $500 for a $50,000 account.
So how many people have signed up for the free service, and how many people have successfully passed it and been funded?
In percentage, the free service, the free accounts the success rate is 0.6%.
Jesus.
And that is kind of terrifying.
Well, the statistic for CFDs is around anywhere from 85 to 90% of people don't make profit. So that's kind of surprising that only 0.6% have successfully gone through what's arguably a really simple, low profit target. And what's the maximum drawdown? You're given a $50,000 account and you can't lose more than 10,000. Is that right?
5,000. It's 10% maximum and 5% intraday. But these percentages are based on the initial capital. So if you grow the account over time, that doesn't mean you have a higher allowance. It's always based on the initial capital, because this is what's insured, basically. Your profits are not insured. If they're gone, they're gone. Nobody cares. From the investment standpoint, what matters is the 50,000 you got on day one. And if you make 70,000 out of it and you lose 20, nobody cares, because there was no risk involved by doing that. But to make sure people don't revenge trade, the limit is set based on the initial investment. So your daily limit will always, on a $50,000 account, $2,500 on any given day. But it cannot be, your drawdown cannot be higher than 10%, means $5,000. Meaning, like, if you lose like 4.9% on day one, and on the second day you lose 0.6%, that means you're over the 5% already. That means on the third day you cannot lose $2,500 anymore. You can only use 2,000, because then you're going to hit the 10% limit.
Right.
But if you're live trading, let's just ignore the enrollment process. If you're live trading and your account is down 7%, and that doesn't mean you're gonna get kicked out. It just don't get paid, because you don't make any profits. I mean, you don't have any net profit. And if you take 3 months to get out of that hole, that's fine. Nobody really gonna put any pressure on you, and that is the good part of doing that. Because really there is no pressure on you getting out of that hole. If it takes you 6 months to do it, so be it. So if you're being responsible with your exposure, you're basically never gonna break these rules. I mean, this 10% rule. If you just account your maximum exposure towards your current state of the account.
Now, your prop traders, do they primarily come from first world countries, or have you found some talent that come from second and third world countries where they really need money? Where that can be life-changing?
That's actually where this free enrollment is designed for, primarily for people that simply cannot afford to invest $500 in something they have no. I mean, like I say, if you live in Central Africa and you live in a hut and you're on a GSM connection, I cannot ask you for $500. That's just not possible. That's never going to happen. And that's what it is designed for. You prove yourself in the community, what you say makes sense, and then you get to trade a trial account. And if that works well, then the company is just going to enroll you without making a deposit. That's basically the idea behind it. But the problem is a lot of these first world countries, people gonna enroll because they just see, oh, I'm gonna get 50 grand. And that's where the most failure is coming from, actually, to be entirely honest. And okay, let's just say 50% of the failure is coming from that. And okay, let's say 70%. And the rest of that is from people who are just not ready yet to do that.
All right, well, that's pretty much all the time we have for today. So, Swing, or should I call you Mario Hennenberger? Thanks for your time. I appreciate it.
Fine. Anything is fine. All right. Thank you.